3 stocks under $5 Wall Street is still ignoring in 2026. Wall Street almost always ignores stocks trading under $5. They're dismissed as too risky, too small, or not worth serious analysis. Most institutional investors can't even touch them due to internal rules. But history tells a different story. Many of today's market leaders once traded in single digits, quietly building fundamentals while the market looked the other way. The real question isn't whether opportunities exist under $5. The question is whether you know how to identify the ones that actually deserve attention. And make sure you stay until the end, because the third company we'll discuss is operating in a space most investors still don't understand: advanced thermal and battery safety technology, and its positioning going into 2026 might surprise you. Before we begin, a quick and important disclaimer. This is not financial advice. Everything discussed here is based on publicly available information and industry data, but you should always do your own research and consult a qualified financial professional before investing. Stocks under $5 are classified as penny stocks and carry higher volatility, liquidity risk, and the potential for total loss. Now, let's talk context. The Securities and Exchange Commission classifies stocks under $5 as penny stocks for a reason. These companies often have smaller market capitalizations, limited analyst coverage, and less institutional ownership. That makes them volatile. But it also means inefficiencies exist. In 2026, with global capital increasingly focused on mega-cap tech, AI software, and large index constituents, smaller companies operating in critical infrastructure, materials, and enabling technologies are often overlooked. The goal isn't to gamble. The goal is to identify businesses with real assets, real revenue, and real catalysts that could matter over the next 12 to 24 months. For 2026, several themes stand out: the global energy transition, electrification, and copper demand, battery safety and thermal management, and infrastructure required to support AI, EVs, and data centers. With that in mind, let us look at 2 under $5 stocks that fit these themes and then zoom out to the broader landscape. Stock number 1, Taseko Mines, ticker TGB. Let's start with Taseko Mines, a Canadian copper producer trading on the NYSE American. Heading into 2026, shares have remained under $5, keeping the company firmly in penny stock territory despite owning significant hard assets. Taseko's flagship operation is the Gibraltar Mine in British Columbia, one of the largest open-pit copper mines in North America. This isn't an exploration story, it's an operating mine producing copper today. On top of that, Taseko owns the Florence Copper Project in Arizona, which represents one of the most important near-term catalysts for the company. Why does copper matter so much in 2026? Because nearly every major macro trend depends on it. Electric vehicles use roughly 4 times more copper than internal combustion vehicles. Renewable energy infrastructure, grid upgrades, AI data centers, and the electrification of industrial processes all require massive amounts of copper. The International Energy Agency and multiple independent research firms continue to warn about structural copper supply deficits as demand accelerates through the second half of the decade. Operationally, Taseko has made steady progress. The company has spent several years reducing debt and improving balance sheet strength. Recent financials show meaningful EBITDA generation during periods of stable copper pricing, and management has been focused on disciplined capital allocation rather than aggressive expansion. The Florence Copper Project is especially notable. Unlike traditional mining, it uses in situ copper recovery technology, which significantly reduces environmental impact, water usage, and operating costs. Once fully ramped, Florence has the potential to materially increase Taseko's production profile while improving margins. Analyst coverage remains limited, but those who do cover the company see upside tied directly to copper prices and Florence execution. If copper prices remain elevated into 2026 due to supply constraints, Taseko's leverage to copper could become more visible to the market. Risks are real. Copper prices are cyclical. A global slowdown could pressure prices and margins. Project execution matters. Delays, regulatory hurdles, or cost overruns at Florence would hurt sentiment. But among under $5 stocks, Taseko stands out as a company with tangible assets, ongoing production, and exposure to one of the most critical materials of the next decade. Stock number 2. Kohl Technology Group ticker KOL. The second stock operates in a very different, but equally important space: battery safety and thermal management. Kohl Technology Group trades under $5 and remains one of the more misunderstood companies in the small-cap technology universe heading into 2026. Kohl focuses on thermal management solutions for lithium-ion batteries and electronic systems. This might sound niche, but it's actually foundational. Batteries power electric vehicles, aerospace systems, defense platforms, satellites, and energy storage systems. Heat is one of the biggest enemies of battery performance and safety. Poor thermal management leads to degradation, fires, and system failure. Kohl's technology was originally developed for space and aerospace applications, including NASA programs. Over time, the company has expanded into defense, energy storage, and EV-related applications. It has worked with the U.S. Navy on internal short-circuit mitigation technologies and has been involved in missile defense and aerospace heatsink development. Financially, Kohl remains early stage. Revenue has grown year over year, but the company is still operating at a loss as it invests in commercialization and scaling. That alone makes it risky. However, what makes Kohl different is its positioning at the intersection of battery safety, defense, space, and next-generation energy systems. One of the more controversial developments was Kohl's decision to allocate a large portion of its treasury strategy to Bitcoin. That move introduced significant volatility into the stock and attracted speculative attention. Heading into 2026, investors need to separate the core business from treasury decisions. The technology itself, thermal runaway prevention, battery safety certification, and heat management, remains relevant regardless of crypto market cycles. Kohl has also received certifications and launched standardized battery solutions for aerospace and defense use cases. If adoption increases and contracts scale, annual growth could accelerate meaningfully. On the flip side, execution risk is high. The revenue base is still small, competition exists, and dilution remains a possibility if additional capital is needed. This is not a conservative investment. It is a speculative bet on battery safety becoming increasingly critical as electrification expands. If that thesis plays out, companies like Kohl could move from obscure to essential very quickly. The broader under 5 landscape in 2026 beyond these two names, the under $5 universe in 2026, includes several other sectors worth monitoring, though with extreme caution. In biotechnology, small clinical stage companies working on rare cancers or targeted therapies continue to offer asymmetric upside, but also binary risk tied to trial results. In energy and materials, uranium-focused companies remain relevant due to renewed interest in nuclear energy, particularly for AI data center power needs. Legislative changes restricting foreign uranium supply have also shifted attention toward domestic producers. The common thread across all these opportunities is not hype. It's exposure to real macro drivers: electrification, energy security, battery safety, and infrastructure build-out. But small size, limited capital, and execution risk mean most of these companies will never become long-term winners. The difference between speculation and informed risk is due diligence. Look at revenue trends, not stock price spikes. Study balance sheets. Understand burn rates. Evaluate whether management has a credible plan to reach sustainable cash flow. Stocks under $5 can be delisted if they fail to meet exchange requirements. Liquidity can dry up quickly during market stress. Dilution through secondary offerings is common. Social media hype can temporarily inflate prices without changing fundamentals. Volatility works both ways. Massive gains are possible, but sharp drawdowns are just as likely. These positions should only represent a small portion of a diversified portfolio and require active monitoring. Stocks under $5 in 2026 represent a part of the market where inefficiencies still exist. Companies like Taseko Mines offer exposure to copper and the global energy transition through real operating assets. Coal Technology represents a higher risk bet on battery safety and thermal management becoming mission-critical across industries. None of these is guaranteed winner. Many under $5 stocks will fail, but careful research, realistic expectations, and disciplined position sizing can turn this space from pure speculation into a calculated opportunity. If you're exploring stocks under $5, start small, stay patient, and focus on fundamentals over hype. Not every overlooked company becomes a success story, but every success story was once overlooked. If you found this breakdown useful and want more data-driven analysis on under-the-radar opportunities heading into 2026, make sure to subscribe. Drop a comment letting me know which sector you'd like covered next: energy, AI infrastructure, biotech, or something else entirely. Thanks for watching, and remember, smart investing isn't about excitement, it's about preparation.